Okay, let's jump right into this explainer. Today, we're putting Daktronics through the absolute ultimate quantitative stress test. I'm stepping into the role of the skeptical equity research analyst. Think of us as investigative journalists for the balance sheet. No hype here, just objective, data-driven analysis pulled straight from their SEC filings to figure out what this company is actually worth. But before we tear into those financials, I need to cover this mandatory disclaimer for YouTube compliance. Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. All right, with that out of the way, let's zoom out. Daktronics just posted a record $838.7 million in revenue for fiscal year 2026. The headlines? They're absolutely glowing. But our job today is to strip away that corporate PR. We need to see if those flashy top-line numbers are actually trickling down to true shareholder value, or if we're just staring at a value trap hiding behind a massive LED screen. Let's kick off our ultimate valuation gauntlet by looking at the lifeblood of any business: cash flow. Our standard discounted cash flow model, using a 10% cost of capital, gives us an intrinsic value of $22.50. If we run an unlevered, free cash flow model that completely strips out their minimal debt, that bumps up to $24. Looking at free cash flow to the firm, comparing it to enterprise value, we get $23.10, showing strong conversion from that $838 million in revenue. And even accounting for Q1 share repurchases, the free cash flow to equity sits solidly at $21.80. We couldn't run a complete adjusted present value model because we're missing some public tax shield filings, but the main takeaway here: across the board, these cash flow models suggest an intrinsic value sitting comfortably above the current $19 share price. Now, the story takes a pretty sharp turn when we start looking at income and dividends. Because Daktronics axed its dividend back in 2020, our standard dividend discount models, including the Gordon growth and multi-stage models, completely fail. They literally return an NA because they strictly punish the stock for having zero payout. But if we shift gears to the residual income model based on their $293 million in book equity, we get $18.50. And their economic value added, which measures operating profit against the capital charge, gives us $17.90. Things get really interesting when we look at market multiples and assets. They're trading at a trailing and forward price-to-earnings multiple of 18.1, but pay close attention to that enterprise value-to-sales ratio. It's just 1.09. That's well below the sector average. It suggests the market is vastly underpricing their top-line dominance. You're basically paying $1 for $1 of revenue. On the asset side, book value is $5.48 a share, and even in a worst-case fire sale liquidation of their massive inventory, you'd still get about $12 a share. We did have to skip the real options valuation for things like R&D, just because we don't have the exact Black-Scholes inputs from the public filings to do that complex math accurately. So this all starts to build a very specific narrative. Look at this dividend history. Notice how despite the record revenues they're bragging about today, income investors haven't seen a single dime since the music suddenly stopped in March 2020, ending with a tiny payout of just 5 cents a share. That abrupt halt is exactly why those dividend valuation models we just looked at completely broke down. Now, as investigative analysts, we don't care about simple revenue beats. We dig into the footnotes. And here are 7 deep red flags the media completely ignores, mostly because complex working capital timing just doesn't make for a punchy headline. First off, that eliminated dividend we just talked about. Second, their free cash flow plummeted year over year from over $78 million down to just $34.9 million. Third, we're seeing extreme net income volatility. Like Q1 was $16.4 million, but Q3 was only $3 million. Fourth, there are looming global tariff risks on components. Fifth, we found a $1.3 million hidden expense hit for their XSTC micro LED R&D buried in the fine print. Sixth, massive seasonal working capital swings are actively draining cash. And finally, their live events revenue growth completely flatlined in Q3, up only 1.9% year over year. But hey, the financial media is a two-way street, right? They also completely overlook these 7 green flags, usually because future contractual cash flows are just too complex for a quick soundbite. Check these out. They entered Q4 with a massive $342 million product backlog. They quietly bought back nearly $23 million in stock, which beautifully boosts yield. They have an absolute fortress of a balance sheet, $137 million in cash, completely drowning out a measly $11.6 million in gross debt. Their Q1 operating margins spiked to an an incredible 10.5%. They had a literal 100% win rate for fiscal 2026 MLB stadium bids. They're physically doubling their SMD LED factory capacity globally, and that XDC IP acquisition expands their tech capabilities without putting any real strain on the balance sheet. And honestly, those factory expansions make total sense when you look at this revenue growth trend. Daktronics has steadily climbed from about $609 million during the 2020 pandemic, all the way to almost $839 million in fiscal 2026. So the demand for these massive audiovisual systems in sports and transportation, it's clearly not just a temporary pandemic rebound. It's sustained, verified growth. So reality check time. How would the legendary investors view this? Well, Ben Graham, the godfather of value, would probably toss this right in the too hard pile. It totally fails his Graham number test, the PE of 18.1 is over his strict maximum of 15, and the stock price is way higher than the net current asset value. But Peter Lynch, the master of growth at a reasonable price, he'd be highly intrigued. The stock easily passes his PEG ratio test. With earnings growing at 24.8% against an 18 PE, the PEG sits at a beautiful 0.72. For Lynch, a PEG under 1.0 means the growth is successfully outpacing the price tag. Now, take a second and look at this number right here, 0.04. That tiny, almost non-existent number is Daktronics' debt-to-equity ratio. And honestly, it's a metric that leads us right to the doorstep of the Oracle of Omaha. Yeah, Warren Buffett would likely take a very serious look at this setup. Does it have consistently high return on invested capital? It's definitely improving, tracking right toward management's 17 to 20% target. Does it have minimal net debt to EBITDA? Absolutely. Like we saw, $137 million in cash totally dwarfs $11 million in debt. Are owners' earnings positive, even with all that heavy capital expenditure for global factory expansions? Yes, they are. And what about the economic moat? It's narrow, sure, but with that total monopoly on recent MLB stadiums, it's clearly expanding. All right, synthesizing all of this data, here is our final verdict on valuation. Averaging out our 21 functional models, and obviously excluding those broken dividend metrics, Daktronics flashes as slightly undervalued at its current $19 per share. Their underlying cash generation and those aggressive, quiet share repurchases definitely provide a solid valuation floor. However, because their project margins and cash flows are incredibly lumpy and seasonal, investors absolutely must demand a margin of safety here. Looking at their economic moat, which Morningstar categorizes into 5 sources like intangibles, switching costs, network effects, cost advantage, and efficient scale, we classify Daktronics' moat as narrow but expanding over the next 3 years. Their true competitive edge really comes down to 2 things. First, efficient scale. They are one of the very few companies that can reliably manufacture and service these massive custom LED formats on a global level. And second, intangibles. They have decades-long, sticky relationships with major sports leagues and universities, which creates a massively high barrier to entry in the live event space. So here is your ultimate takeaway. The quantitative models, backed by methodologies from guys like Peter Lynch and Warren Buffett, are pointing toward undervalued growth, totally fueled by a massive backlog and a fortress balance sheet. But those hidden red flags buried deep in the free cash flow statements and working capital swings, they suggest there could be a seasonal storm brewing that the mainstream media is just missing entirely. The models are pointing one way, but the footnotes are screaming another. Which side of the trade are you on? Get into those SEC filings and do your own homework.